Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, and see what people are sharing. If you want to follow me on here, at finding_finance, and if you want to join our community, finding-value.com. That's where I dive into everything, looking for potential investment opportunities and sharing those opportunities with everyone. I also go over some fundamental analysis, some technical analysis. I do all of that stuff. So HFI Research says this chart is about to look so dumb. It will be one for the record books. And again, this is JP Global Implied. He keeps updating this as we continue to draw down global total oil stock. Now, some people are probably wondering, well, how come oil's not going up? We need money flows to come into oil. Seasonality wise, February is a month where things do bottom. I think that when we go through next summer, we're going to draw these down if prices stay where we're at. I mean, we could substantially draw it down. So if we draw down the commercial inventories, the fair value today is about $84 a barrel. It's just going to continue to put us more and more undervalued. So maybe this summer we get into the 90s, maybe even $100. I'm not sure. But if we continue to draw down inventories, that is a positive thing for higher oil prices, irrespective of what the short term is doing. This is the fundamentals and the inventory levels that drive it, that drive price higher. XPT, this is when platinum breaks out, and this is divided by CPI, the Consumer Price Index. It says, Casper says, it has some catching up to do versus inflation. 250% to get to its 2009 high. And remember, that is the outperformance against inflation. So if we do get an inflationary period, it's going to go up 3.5 times the rate of inflation. Here's your big squeeze into 99, 2000. Breakout, retest, and then a rip. Here's our squeeze again. Right here at any second, we're going to break out, I think. Could it be another 6 months? It could. But we're squeezing into this corner here, looking for a potential breakout against the Consumer Price Index. Dow versus gold rotation signal number 4. I know North Star's been really hitting up this capital rotation. I'm interested. I watch this stuff. I watch this even not with his charts. I have my own charts. But he does a good job and he shares this, and I'll share it with everyone. But in his opinion here, he says a huge gold bull era and stock market crash. It's likely to take many years to recover. Willist, its recovering precious metals are expected to massively outperform. This is the capital rotation events that he talks about. We had this early, back in the 1930s, a big move lower where gold outperformed against the Dow. Dow also underperformed here in late 60s, early 70s. We saw the big move in 1970, but this started to break out in 1966, 7, probably somewhere in that range there, 67, 68. So there was a year or two where this went sideways before we had a big move. We are breaking down through everything right now. We've broken down through critical support. We've kind of got that rolling over look. We've broken through this rising trend line. So at some point soon, I can't tell you guys exactly when, but at some point soon, we are going to see an acceleration of gold. I know that sounds weird. You guys think it's gone up a lot. We're going to see an acceleration of gold against Dow Jones and S&P. And we could see these roll over too, Dow Jones and S&P 500. We're also going to see commodities rip. I mean rip. And that's what people, I don't think, are ready for. So he says, this is the quarterly candle chart. That means each red or green candle represents 3 months of price action. If it falls below critical support, we have an even clearer quarterly breakdown. That would imply an increasing likelihood of the S&P 500 falling 50% or more, and gold rising hundreds of percents. He is charting Dow Jones to gold ratio and what did the SPX do each time. So uh, this is the setup, guys. This is what everyone should be watching. Um, we're in this capital rotation event. We've got inflation, interest rates are going up, and that's what's causing this rotation. If you guys want to know the cause of it, in my opinion. Coming down, we got another North Star one. Gold has outperformed the New York Stock Exchange Composite Index by 300% since the year 2000. And it should outperform it by another 1,300% in the next 10 years. Chew on that for a while as it blows some narratives away. And what he's got is this bottom pattern we've broken out already in gold versus New York Composite Index. The outperformance of those two assets against each other is projected to go up 1,310%. Very similar to like the 1970s back here. You can see this big move that was up 2,000%, a 20 bagger, 21 bagger to be exact. And now we've got this big move. The bottom occurred in 2000. There was that kind of move up. It went up 644%. We had massive moves from 2000 all the way to 2011. We had a consolidation, and now we are breaking out again. So everything's underway, guys. Commodities are the spot to be, and money's going to rotate into it. And they're going to start to pop off like popcorn, one at a time. And then certain sectors are just going to go boom, boom, boom. They'll all start popping off. 7 million barrel per week draw in U.S. commercial crude from an already low level. Do you know how much the algos will love this crap here? So this is U.S. commercial crude storage. We're coming on up in 2025, and this is how low we are in relationship to everything else for other years. We're on the low end. We're eating through inventory. That is bullish, not bearish. BNN, Eric Nuttall, he says, Meg Energy. U.S. hedge funds are shorting Meg due to tariffs. Cash flow would still be 10% with tariffs. They could buy back 60% of their stock over 5 years, which may triple the stock price from today. I don't know if that's how tariffs work. I think Meg will still make the money on oil, and I think the tariff will be applied to U.S. consumers, not the company of Meg. So I'm not sure if his calculations are correct here, or maybe I'm not correct. I think that the tariffs are going to be applied where the refiners get the oil, and then the consumer at that area is where they're going to pay the tariff. But maybe I'm misunderstanding some things that I read about tariffs. Christine Guerrero says the U.S. has less available drilling rigs now than in the last 70 years. Production can't rise without more active rigs. When that call on supply happens, margins will squeeze higher for the energy service rig guys. So there's the decline, and there's our decline coming back down. Available rigs continue to go lower. Active rigs also go lower. So it's probably old rigs being retired. Here's your U.S. available rig and utilization rate. We're at 64% for utilization rate, and available rigs continue to decline. So when we get a squeeze in oil and oil prices go up, they're going to squeeze the rigs. The rig utilization will go up, and then your day rates go up. Carl or Carol, I'm not exactly sure how to pronounce that, but Donald Trump has now imposed tariffs even on the U.S.'s closest allies, fueling inflation. And in times of inflation, commodities tend to be the best investment. Today's chart shows the Bloomberg Commodity Index. Despite market turbulence, commodity prices are rising. If Trump continues down this path, I wouldn't be surprised if the price surge of 2021 repeats in 2025. So we could see another price surge. Commodities have already broken out for the Bloomberg Commodity Index, and things are looking good for commodities. I would have drawn this a little bit tighter on these if it were me. Coming down, the Kobayashi letter says this has never happened before. The top 10 largest US stocks now reflect a record 75% of the US equity market. This percentage has surpassed the previous record set before the Great Depression in the 1930s. By comparison, at the 2000 dot-com bubble peak, this percentage was at 73%. The top 10% of stocks as a percent of total equity market cap has risen in a near straight line since the 2008 bottom. Furthermore, the top 10 stocks in the S&P 500 now reflect a near record 40% of the index. The market has never been so concentrated. So when you get these concentrations at the end, so the large concentrations are a signal that we're towards the end of the bull market. You can see where these peak out at. And I don't know if we're at the exact peak, but this is generally where things start to roll over, is when it all gets consolidated into a few companies. So we're at the highest concentration here ever, which most likely means that we are very close to a peak. Razor Oil says this is probably from 2023, but you get the idea, friends. Hearing too much about Venezuela replacing Canadian heavy and how US doesn't need Canadian heavy while simultaneously barely producing any heavy oil. Those new Palisades and Malibu Road Plus construction, cement, and new house materials won't be made out of American propane, friends. Top 10 heavy oil producers, Canada being the largest. And here's Venezuela. You cannot replace Canada by sheer volume here. Venezuela would need to increase production dramatically for that replacement of Canada if they're going to try to replace it. So, yeah, heavy oil is used in a whole bunch of different stuff that we're going to need to use. Golden Toilet, when do my junior miners go up 5 to 15x? Still waiting for that part. I think it will go up when tech rolls over. I think we need money flows, that capital rotation event. We're watching it. We're seeing the beginning stages of it. So if we go up here and we look at these, we're starting to break out. This is when we're going to get big moves in some of these commodity mining companies, oil, platinum, silver. It's all set up here. So I think we're in the process. We're just really early and we just got to wait for it to come. So that's when. It's when money starts to rotate from other sectors into ours. Make seasonality great again. Remember, your bottom's in February here. Keep your eye on the ball here. Keep your eye on the ball. That's what's coming. In terms of seasonality, it doesn't mean that we'll 100% get this. But here's some good things. Combine seasonality, where demand goes up for summer driving season. Combine that with where our inventory levels are at, which are ultra low. So where do you think the price of oil is going to go when we hit our peak driving season coming up here in summer? It's probably going to go higher. What are you telling me? Drill baby drill is toothless and Saudi OPEC Plus will not flood the market. Energy fantasies versus energy reality. This is U.S. President Donald Trump has called for a surge in oil production to help tamp down inflationary pressures, but has faced pushback from his allies in the U.S. shale industry and Saudi Arabia, according to Wall Street Journal. Citing oil executives, and the Wall Street Journal reported that even if Trump moves to wipe away many regulations on the energy sector, an American oil boom is unlikely to transpire as companies focus on reining in costs and returning cash to shareholders. People who advise Trump have also conceded that U.S. fracking businesses will not pump more. Sources familiar with the matter told WSJ. Trump's best chance to lower oil prices would be to persuade the Organization of the Petroleum Exporting Countries, OPEC, and its de facto leader, Saudi Arabia, to increase supply. But Saudi Arabia in particular has let former U.S. officials know that it is not willing to expand global oil supplies, and WSJ report said, adding that this message has been passed on to Trump's team. Clash is looming between Trump and Saudi Arabia over oil prices, one of the former officials told WSJ. ISM manufacturing PMI back in expansion mode at 50.9. So here we are rolling higher. That's a good thing. We saw inflation increase in oil during these increases of ISM manufacturing PMI. This is really good. So hopefully we can get above 50 and start rolling higher, which could be an inflationary impulse surge. Chip brokers, China set another annual record for iron ore imports in 2024, reaching 1.24 billion past 2023's record breaking volume of 1.18 billion tons. And this is all getting shipped. So iron ore imports continues to head higher, and that is going to be good for shipping. North Star, another capital rotation chart. He says, as far as I'm concerned, the only chart that matters right now, the capital rotation event, was expected to happen when we break out of the orange segment. It was expected to happen when we break out of the orange segment above 0.5. If when it happens, monthly close basis, it's game over for the stock market and crypto, and game on for gold. And I also think it's going to be game on for commodities. Because when precious metals outperform, generally what's happening is you get a weaker dollar. A weaker dollar is what commodities are priced in. So hard assets that are priced in dollars go up. It's that simple. Money starts to rotate towards stronger currencies, depending on what currencies are stronger at that time. If emerging markets start to outperform the dollar, their currencies, you'll see money flows go into emerging markets as well. So this capital rotation event, it's happened many times in history before, and we are getting closer and closer for that to materialize. Here is Grady. He said last weekend that platinum is now seriously thinking about going for a mega breakout. And it had at the service expected a big push this week, and now it has a historical breakout with a monthly close above the 17-year blue line. Just like silver was, platinum was sitting right behind its historical huge blue breakout line. It has been in a cyclical bear market for 17 years and was about to break out and resume its secular bull market. A generational breakout and opportunity was incoming also for platinum. Platinum has been basing out for about 10 years, just like back before the start of the secular bull market in the 1990s. This blue breakout confirms the resumption of the secular bull market for also platinum. And the blue breakout also confirms that wave 3 has started, which is the strongest and most profitable phase. Platinum has a very, very, very long way to go. The posted ratio charts look fantastic. What the exact final target price will be is not important right now, really. What's important is to get ready and to get real guidance along the way. So even before I called the commodities bear market low back in 2020, real time, I said platinum will outperform gold and silver in the coming bull, pioneering platinum case on FinTwit. Many will now wake up to platinum and palladium, but go with us. I have played these sectors for decades. And here's the breakout, guys. Platinum monthly log chart breaking out on the monthly, on the closing prices. We'll see if we can get a big move here. Patience, it's coming. It is coming. Here's platinum quarterly chart also squeezing up there, ready to break. Let's break this thing. Crypto started detonating as soon as they stopped U.S. aid from laundering money. I'm not exactly sure what's going on here, but it looks about aid. It's about coordinating clandestine operations through foreign left-wing NGOs with the $50 billion budget. It even surpasses the budget of the CIA and State Department combined, says Mike Benz. Peter Schiff says, in response to market turmoil, investors are turning to what they perceive to be safe havens. Some are buying dollars and treasuries, while others are buying gold and Japanese yen. But investors are selling risk assets like Bitcoin. Bitcoin is not digital gold, it's digital risk, in his opinion. We saw a pretty stark reversal in Bitcoin. I think it could still go higher with that big reversal. Again, I'm not playing that market. I'm not in it. I don't want anything to do with it. I'm in the hard assets, the physical assets, but that's what I saw here today on Monday when I'm recording this in Bitcoin. Silver's at a lower price now than 44 years ago. Wheat is at the same price now as 44 years ago. This does not make much sense, really. Silver's coming ballistic move will help people survive. Wheat's coming ballistic move will have a very different impact. The commodities bull market is a lifetime opportunity and also a threat. And here's wheat, and you can see the parabolic base that it's built and ready to rip higher. And a lot of things, silver, gold, wheat, I think palladium's got it. There's a whole bunch. So I'm interested to see where this thing goes and how this plays out. I hope people don't get too hurt by it. 3-2-1 crack spread, tariff going straight to consumers. Higher refining margins support higher crude prices, and crack spreads is your refining margins. It's converting oil into usable products, and that's the spread between the two. So the spread going up, I do think that tariffs have something to do with it here. Rock bottom entries, natural gas prices are gapping higher, fueled by US-Canada trade tensions. This is a critical input for fertilizer production, with Canada supplying 80% of the USA's potash. Expect agricultural commodities and food to become a lot more expensive. And we just saw wheat up here on this parabolic base, natural gas. We've broken out. We are doing a retest on support here, and we'll see how much higher we go here in natural gas. Shoulder, head, shoulder, and a potential move on up. I don't play, I'm all about the long term. I think nat gas has a long way to go. The equities, the pricing can go up and stay high. If it just stays high, the equities will continue to go higher. So it doesn't have to go up. If it goes up and reaches levels that are very, very profitable and stay in the profitable area, that's where you get the outperformance of the equities. Peter Sutherland says, oil will not hit $100 this year due to tariff Sturm and Drang. Oil will hit $100 this year because Russian exports are plummeting. U.S. production is overstated, crude cut, and rolling over, and OPEC will not repeat its 2018 mistake of relaxing cuts before additional physical market disruption. So Peter thinks we're going up, maybe even $100, and it's due to those things, not because of tariffs. But that's what I've got for today, guys. That's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. Special is the coupon code. And we'll catch you guys next time. This is Finding Value.